And good afternoon. My name is Jim Angel. I'm a finance professor here at Georgetown University. And I'm very pleased we're now going to have our discussion on exchange-traded products. We have the most notable luminaries in the field here. We've got Reggie Browne from GTS, Dan Draper from Invesco, Ananth Madhavan from BlackRock, Dan McCabe from Precidian, and John Zimmerman from IndexIQ. So welcome to Georgetown. Thank you so much. We have a lot to talk about today. Now, this morning we heard the CEO of the World Federation of Exchanges say, now is the time for ESG investing. So there's considerable interest in sustainable investing. How do you see the ETP market evolving to fit this need? Who'd like to start?
Let me take that one, Jim. So, you know, the ETP market has grown quite a bit since the mid-90s when it was all focused on U.S. equities. And we've seen increasingly diverse offerings, particularly of ESG products in recent years. So the flow into the products has been quite remarkable. Understandably, because the data is there and there's the possibility for long-term engagement through proxy contests, the initial focus was very much on equities. But what we've seen increasingly is interest in bond funds that have ESG characteristics. So it's an exciting space. It's a fast-growing space. I think there's still a lot that we have yet to learn. So one of the things that I think is very interesting is as we create these funds with various ESG attributes, they also have perhaps attributes in terms of factors. And by factor, I mean broad and persistent driver of returns. And we have factors in fixed income and we have factors in equities. So sometimes what we see on the ESG side is that a deliberate loading on ESG factors may lead to certain sectoral or industry or certain other types of loadings that are different from the market, and those have return consequences. I think that's the new frontier of exploring that.
I'd just add, I think within ETFs, given the data and the largely passive nature of ETFs, you're really going to see a further sort of adoption of a broadly acceptable sustainability screen within equities first. I think you're starting to see that. There's a number of products out there, but the broad acceptability hasn't really been there. So I think that's kind of what you're going to see in ETFs. Outside of ETFs, you'll see a lot of opportunity for selection and customization, if you will.
Like I just add, on a global basis, we kind of in our global Invesco ETF business see really the demand in Europe. So I think in our UCITS range, that's really where the Europeans, I think Scandies, the Dutch, many others have really taken the lead really over decades, and it's almost becoming table stakes. If you're looking at a large institutional mandate or whatever, it's just assumed that you're going to be ESG driven. So I think there's demand to have ESG branded products. But I even think if you're a fund manager index that eventually your screened universe you're starting with is going to meet certain basic criteria that's frankly going to be dictated starting at the boards of the constituent companies down.
So speaking of ESG factors, how can exchange-traded products help increase financial inclusion to the unbanked and underbanked? Who'd like to take that one?
I think you've already seen it some, right? You've already seen it with the broad-based S&P 500 ETFs, bringing costs down, bringing access to the masses, if you will. Any brokerage account can access them. So you've already seen that a lot. I think over the next few years, you're going to see that continue. Fixed income is already there, but the percentage of fixed income isn't close to what it is in the mutual fund market. You're going to look at other asset classes. IndexIQ has liquid alternatives that are going to continue to grow, I think. So you're going to see more of the democratization of funds through the now free to trade, daily liquidity, efficient ETF structure.
If I could just add there, if you look at the innovations happening in the marketplace, particularly around the retail platforms, with Schwab being the leader of reducing their fee for retail participation in the marketplace, the cost of access to the market is now low to zero. And as this esteemed panel introduced new concepts and new innovation in the marketplace, the access to retail is gone up. 7.8 million households have direct ETF exposure. If you look at the growth of ETFs, with the competition of bringing costs down globally, actually, but here in the United States, I think the barriers into areas around assurance delivery, the banking sector, retirement, and even this new investor class who wants the transparency and they want to have the ability of choice through mobile phones and to other devices. All this is going to just cause, I think, those who are not participating in financial markets currently to move closer into the system, actually. And one addendum, look at Schwab again with their going to fractional shares. This now speaks particularly to high price equities like Google and others that are trading in a large price terms per share. But fractional shares have always been around. It's not a new concept. They're just making it easier. And so to move a new investor class closer to investing and to introduce the power of capitalism, and ETFs are part of that story, I think is a wonderful thing.
If I could just add to that, Jim, I think lowering barriers to entry is what we're talking about, and I think the SEC is doing things like that with the ETF rule, kind of making it easier to bring product to market. But I think what we're going to see is banking product come to market. So money market funds, things that Reggie's talking to, maybe insurance products, insurance vehicles, things that people don't have access to in an exchange wrapper today. I think over the next decade we're going to see get there, and then it's going to be a matter of how do people access that? What type of accounts do they need to have in order to be able to get there? But one of the things that the ETF business has done better than many businesses in the country is evolve. The business is only 25 years old. Inside the United States, we have over you'll know the number, 4.3 trillion in the U.S., something like that today. It's pretty dramatic growth, and we were just saying, and I agree with Dave Laval from earlier. I still think we're in the first or second inning. I mean, I think that the exchanges are a phenomenal vehicle for driving efficiency.
And if I close on this, but I think the wider ecosystem, just down the road, the CFP board, for example, better financial planning practices, and the innovation technology to have even lower cost models, subscription-based access to information, asset allocation, financial planning, all that's really going to support these lower cost, more efficient products, which we trade and manage every day.
So I'm hearing about lots of innovation in the ETP space. So what's the next big thing in ETPs? What other kinds of innovations do we see coming down the line? I hear banking products, I hear other stuff, fractional shares. So what are some of the other innovations we should be looking out for?
Well, I think you're going to continue to see tremendous growth in fixed income. So if you think about ETFs as a fraction of the shares of all bonds out there, it's less than 1%, and indexing is probably 2%. So there's a tremendous opportunity for bringing the advantages of ETFs, that is diversification, low cost, transparency, to the fixed income markets. And I also think that will continue to be an area of growth. I think what we will see, getting back to your first question, Jim, is a layering in of more complexity in the fixed income space. So more indexing with views towards ESG considerations, with views towards deliberate factor tilts. So perhaps tilting towards quality. So many ESG attributes load on higher quality companies or safer companies, and that could be a great space for innovation. So I think that's where I would see actually a lot of the dollars going in the next 5 years.
I just think that the amount of innovation that is occurring in ETF space, but also now the new layer of complexity, particularly around 40 Act vehicles having options embedded, where they're either buffering the downside or giving a return through a buy right strategy. These are all very complex type strategies that are not meant for all investors, but if understood well with proper diligence, can be deployed in asset allocation models successfully. And I think this illustrates the need for further education across the community, which I know the community is striving to do it in deeper and more profound ways. But particularly to your question, I'm pretty interested in the coming disruption in the variable annuity market. There was a recent legislation proposed, not passed yet, being held up by some senator over his personal views. but particularly around variable annuities, it's a $3 trillion marketplace. Fees are generally north of 1% for a variable annuity. And once ETFs are going to be introduced, and they're there now in certain cases, those fees are going to be driven down 50 or to 75%, and just to benefit the end user of a variable annuity. And so that just illustrates just the power of innovation through the ETF structure, but also calls for deeper education and deeper engagement, particularly to all investors.
If I could add to that, we've talked a lot about indexes here. One of the things that I think that is going to be a major revolution, frankly, in the market over the next 5 to 10 years will be active management coming to an exchange-based model in what we'll call a price transparent vehicle. And we recently did receive SEC approval to launch products that have the same disclosure requirements that today's 40 Act mutual funds have, but will have the efficiencies of today's ETFs. Through the in-kind creation redemption process, we'll be able to eliminate low-cost basis shares, so we'll also be able to eliminate transfer agency fees, 12b1 fees, reduce cash drag. All these will go to the benefit of that active manager to be able to compete against the passive index provider. And when we look at that opportunity, we're talking about today in that $4.3 trillion US listed market, only 2% is represented by active management. So if we can begin to port those assets over the next decade, and we are working with some of the largest, matter of fact, on both sides of me, some of the largest managers on the planet to do this, I think it's a massive benefit to the ecosystem in general. It's going to be very healthy for the market making community to be able to touch more order flow, hopefully disperse liquidity away from end of day, because now I think we have 38% of the volume trading in the last half hour. So, it would be good to be able to disperse that. And then, also very, very beneficial to the exchanges to have an increased liquidity on the exchange itself.
Yeah, I'll just echo that, what Dan's point on active management. We see that continuing to grow within the exchange-traded product segment. We have, at IndexIQ, we've leveraged some of the other New York Life Investments boutiques to already bring to market some fixed income ETFs. But I think with Dan and Precidian's technology that they've developed in the active share model, we are licensing that, and that will bring the possibility of exchange-traded products for a lot of our equity boutiques that are actively managed and have a long history of that. I think it's just an illustration why that is something that I think asset managers are excited about, and investors right now may not be clamoring for it. I think as those products are going to build track records at efficient prices, those are going to start to grow over the coming years.
Mm-hmm. And to that point, I think this dichotomy between active and passive is overdone. I mean, it was a useful construct maybe a decade or two ago. What we were increasingly seeing is that these products are blending. And so, for example, when we talked about ESG, even if I just exclude companies from a particular ESG index, that is going to put in a little bit of a tilt in some form or the other, usually manifested in terms of a size or quality factor bet as well. And so these things all have ramifications. And so I think it's useful to see that's where the industry is going, of blending the best of both styles of management.
Yes, and I've been trying to get rid of the word passive from investing because most of these so-called passive products are used in anything but a passive manner. People are making very active asset allocation decisions, and when you see the trading volume in these so-called passive products, they're being used in anything but a passive manner. But speaking of all the innovation in more actively managed ETPs, now we have non-transparent ETPs. So what kind of challenges do non-transparent ETPs bring to the market?
I'll take that one. Well, first, to Dan, to his credit, he's worked a long time to bring a non-transparent structure to the marketplace, and others are there in front of the commission for approval. I think largely active managers are very protective of their intellectual property, and so you need a structure that allows them to present alpha to the marketplace, but to engage their client deeply. And from a trading perspective, and a lot of time has been spent, a number of years exploring how this structure will operate in a stress market, and then particularly how investors would experience, what their experience would be. And so from my point of view, and I'm a proponent, I'm a market maker, I'm prepared to risk my capital. As long as I have an understanding of fair value, I get a sense for the complexion of the basket, and I can buy a basket real time through a third party, I feel as though that the marketplace, through a couple of observations, would become comfortable quickly over this type of structure that allows the active manager to come into the marketplace. So I think just a couple of periods of real life trading, and the marketplace firms up pretty quickly. We're talking about a large cap, long only basket that has a high correlation to benchmark futures. And so it's very easy to put a hedge on and measure your risk remaining overnight. And I don't suspect that these instruments will be held by the marketing community for a long period of time. And there's a low creation basket. You put it on, you help investor get in at a competitive price, and you hedge your risk real time. So I personally think that the experience in the marketplace will be positive. The academics will have an opportunity to measure and infer some empirical data over a couple of quarters. And after that is done, I think the marketplace will firm up pretty quickly.
If I could just add to one thing there, and I think it's really important. We talk about intellectual property, we talk about intellectual property of indexes and everything that goes behind that. And to Reggie's point, the majority of active managers have stayed away from the ETF space because they couldn't protect their intellectual property. So now they finally have a vehicle that they can do that, so they can come out and compete on a level playing field. And we talk about front running, right, and the impact of front running on performance. But as important is free riding. If I have to disclose or I disclose that information, I no longer control my intellectual property. So whether that be a proxy that really highly correlates or the actual portfolio, if I'm transparent, we see what happens with vehicles. The cost gets driven to near zero in these big index products. And therefore, then the parties won't expend the capital to develop those concepts to be able to serve the investor. So I think it's important that we have something like this to allow it to compete, because I think a more balanced ecosystem on the exchange is better for all of us.
I think if I could add too, I think kind of your question about active and passive and the blurring, but even if you could almost imagine a 2x2 box, because I think at least one more level of attribution is if you think about what is active portfolio construction, what is passive, or systematic, if you will. And then you go to the implementation. So basically, what is active implementation? So I think even having that discussion about, I think a lot of people just stop at the portfolio construction piece. Now with the capital markets, the law of one pricing coming in real time, you can be, say, systematic or more even kind of index rules based, but very active in your implementation as an active manager or vice versa. And I think that's going to be kind of an interesting theme. And again, academics like you can help really attribute. And this concept that institutions have been doing forever of risk budgeting. Where do I want to allocate, quote unquote, active risk budgeting? It's going to be available to the masses, right? Which is powerful. Can the education there? Can they understand it? What is the right price in portfolio construction I can pay around risk to build better portfolios? And then your original question, I just think perhaps one of the biggest challenges from a business perspective is just distribution. For many financial intermediaries and gatekeepers, there's an existing multi-decades model in place. How does that change and adapt to this new technology?
How do you think it will change?
It's interesting. I mean, you can kind of get a predictive path, but I think typically it's exogenous variables you don't expect that come in and change. I do think, personally, if you look at the majority of the wealth is still in certain older demographics, slower to move, but as that accelerates and does move to younger consumers, there's a wealth transfer. I think certainly the acceleration has a higher potential there. But it's a big dilemma. How do you have, as we've seen, I think in ETFs over a couple of decades, whenever we've had a big market correction on a market share basis, ETFs have always benefited in the recovery. I'm not hoping for that, but again, you could see a couple of outside factors, playing to accelerate this.
Yeah, I think one of the very interesting factors is the growth of models. So by models, I mean, various advisors and so on have largely ETF ETF constituent models, and they have offer a range of models to their clients. and the number of followers is growing by double digits. So it's a huge driver of change. It'd be very interesting to see, if there was some major correction, what the changes in sentiment among the model builders is. But I think we're still in the early days of seeing a lot of growth in models, and that will shape our industry as well.
So I hear this correction word coming up over and over again. Some people are afraid that the rise of index-based investing and ETFs is going to actually cause the next correction or worse. What do you think about that? Are ETFs becoming a crowded trade that will somehow cause some kind of massive exodus event from the market?
Well, a couple of points, right? So ETFs are just a wrapper. So I think, it's just a way of grouping stocks or bonds into convenient portfolios that can be traded on exchange. As I said, overall index penetration, we've estimated in a white paper we posted on our website, that less than 24% of U.S. equities are held in all index products, including institutional indexing and ETFs. That's not a big number. Keep in mind also that the turnover of index products is something like 7% versus the turnover of active products, which is more like 80%. So the money in motion is very different. I think the idea that indexing, which is, index funds are price takers. We take price as given. And it's hard to imagine that's going to cause prices to deviate from fundamental value either up or down. So let me stop there.
I'd say, look, from the Dutch tulips to U.S. mortgages, whatever, prices have had one common variable, leverage. And aside from a very small percentage of, short leveraged ETF, these are pass-through vehicles, as you said. Yeah. They just simply reflect the underlying market.
We've heard a lot about innovation and these various things, and we've heard about market making. What can be done to strengthen the infrastructure of the market, such as the authorized participants? Do we need to be making changes there? What should we be doing so that as we see more products, as we see more dependence on these products, we have a more resilient market infrastructure?
Well, I think it's pretty resilient as it is. There's been committees sponsored by the Commission to look at, and currently there's one now in fixed income marketplace, but we had a long exploration review on the equity markets, and there's been several roundtables. I think for the most part, the resiliency of our marketplace is pretty resilient, and the result of Reg NMS that came to marketplace in 2005, fully implemented in 2010, has been successful. Not one exchange is dependent. The marketplace is not dependent on one exchange, not one participant. There's a lot of diversity, and the experience of the retail investor from a market access perspective and execution quality is as high as it's ever been. So if you look at the outcomes, all positive. I think you look at market structure in particular, from a listing venue perspective, I think the market structure is not well suited for all types of companies. You can't treat a small cap company in market structure like you do a large cap. So these are all complex, wonky stuff. But from an investor standpoint, I think they're having a good experience. From a listing point of view, I think there's work to be done. How to do all that, there's a lot of complexity there, in my opinion.
I was on this SEC committee that Reggie just referenced, and one of the things that we saw in terms of strengthening the system was just to make more data available in a more centralized and accessible way. We're already starting to see that. So for the academics in the audience, there is a goldmine of data on authorized participants in the form of the NSEN data that the SEC has made public. Gives you some real insights into who the players are and kind of what they're doing. I think, again, having a standardization of how one creates and redeems and the ability to see who's doing what, I think is all just beneficial. I think to Reggie's point, I would totally agree that the system currently is very strong. So these are marginal improvements, but we're always looking for ways to make it better.
And just to add to that, over the last whatever number of years we've been working on trying to get this price transparent ETF out to market. I've watched teams like Reggie's team interface with the very largest custody agents out there, and it's really quite remarkable how well they work together, and it's that ability for these guys to be able to function really smoothly across each other that has made the system as solid as it is today. And to hearken to the question that Reggie was alluding to, as far as support for individual companies potentially, or smaller stocks being listed, smaller ETFs, I think that the exchanges have to, and I think the New York Stock Exchange is trying to do this now, right? Where they're kind of coming up with a hybrid model on being able to incentivize market makers a little bit differently. That's something that I think would be a benefit to at least test to see if it works.
Sure.
So we're here in Washington, where we manufacture lots and lots of regulations. If you were going to change one thing in the U.S. regulatory system, what would it be? Or one or more things?
I would suggest something along the lines of broader flexibility on educational materials and educational conversations that can be had with investors. To the points that were made earlier, I think the continued complexity of exchange-traded products that are available to everyone is a good thing, but there needs to be ample education that goes with that on how the products are constructed, what to expect from returns in the future, and any sort of risks that go along with that. I think there can be improvements in the current structure there.
Since this is a panel on exchange-traded funds, I'll just repeat something that we've talked about before, which is this idea that we need a classification schemes to help investors who may not be experts in this area sort through. So, for example, a product that is really an exchange-traded note, many in the press or sometimes retail investors will call it an ETF, and the term ETF is used quite generically for products that have embedded leverage in them, that are maybe based on things that aren't physically can be held within the wrapper. And so I think having a sensible nomenclature would just help everyone out.
If I could add at a high level, I mean, I spent kind of 14 years of my ETF experiences outside the U.S. And I would just say that we take for granted here in the U.S. To have a singular, the world's biggest capital market, and to be able to have generally one clearing settlement system, and even though a handful of exchanges, but one currency, that we really can't take this for granted. So I say to policymakers broadly, I mean, congratulations. I think the ETF rule, great step in the right direction. But if we're thinking about a global competitive capital markets, how do we not take for granted really the benefits of the U.S. competing, providing transparency, lower costs, all these benefits, not just the U.S. People, but a huge percentage of our products are held abroad. So we can really think in the global landscape, and competing regimes like UCITS and others are making, they've made some modernization, they've made some changes viewed differently in the world. How can we remain competitive? We have smart people are on it, but how can we kind of do more, especially moving in the digital space and other areas, we're going to see a lot more competition outside the U.S. for our capital markets.
So how is European regulation affecting ETPs, not only in Europe, but outside Europe?
GDPR?
GDPR. How many of you know what GDPR stands for? How many of you would like to know? Yes, it's the European personal data rules. That's why when you go to a website, it always asks you to accept the cookies.
I think aside from GDPR, there was some tax legislation that was passed a couple of years ago looking for American accounts in Switzerland or outside the United States that invariably changed some of the investor behavior of foreign investors investing in the United States, but now has bypassed the US market to go into UCITS products or European products because of that. So we have to be careful of the unintended consequences of regulatory changes and how we look at globally investor behavior, because some of my largest clients sit outside of the United States that love to invest in US markets, but we become less competitive because you pass rules that now change behavior, and they switched to other marketplaces that have lower regulatory regimes. If you think about the launch of ETFs, I was around for that in not ETF community, but I was in the field. ETFs, came into the marketplace in Canada because they had a lower regulatory burden to launch in Canada in 1990, and the Supreme Court had ruled in favor of an index license and a trademark issue that prevented the SP 500 from launching here in the United States. And so competitively, we have to make sure that we're always competitive and that our marketplaces are resound because of that, but we don't lose leadership globally because of just small changes of rules that changes behavior of investors of all stripes.
I think a general observation is that the regulatory framework outside the U.S. is evolving, and I'll point to MiFID II as an example in Europe, where you had sort of voluntary disclosure of ETF trades, which is now required, and you see the volumes triple after that rule change. So in other words, 2/3 of the trading in ETFs was going unreported. That's a huge difference in terms of the level of post-trade transparency. And so the marketplace becomes visibly more liquid than it was before. That in turn has many beneficial impacts all through. And I think those kinds of changes are there, not just in Europe and in the Asia-Pac region and elsewhere as well.
Now, again, here in Washington, we see some presidential candidates talk about imposing a financial transactions tax on trading. What impact would this have on ETPs?
It's a terrible idea.
Don't hold back, Rich.
It's a hidden tax to households. Let's step back. There was a special system here in the United States where human beings controlled the trading of stocks. And the SEC did some studies and decided, let's make it electronic, and now you have marketplaces that are resilient and it's not dependent on one market center. Successful outcome. And now there's this theme that high-frequency trading is a bad concept, and so some politicians wants to regulate and tax high-frequency people because they're the one that they deem are bad actors, which is not the case. And this view of the financial tax is to get high-frequency folks, but really is to get mom-and-pop households. And this is going to be a hidden tax that spreads will widen, given that tax. And just look at the UK, for example. If there's stamps taxes in that marketplace, there are stamp taxes in Hong Kong, 10 basis points, but ETFs trade 30 bips wide because it's a three-sided tax: ETF, buyer and seller, and a trust. And so I don't think there's enough empirical evidence by the academics to explain this to those who propose this idea that spreads will widen out and households will pay it directly. And it's just a concept that will hurt savings. It'll hurt every aspect of the investing economy in a terrible way.
If I could add to it, I think Reggie nailed it. You got two case studies, UK and Hong Kong, for example. You can look at the impact. I agree. I do think it hits the consumer. But also, capital markets are efficient, and they find ways. And if you look in Europe, the evolution around some of these stamp duty issues was synthetic products. So all of a sudden, is it an unintended consequence that effectively under UCITS and UCITS ETFs, you can get around the UK stamp duty by effectively replicating the ETF in a total return swap and holding non-UK equities. So all of a sudden, when you ask these questions, but a lot of the cost is passed on to the end consumers, but again, in an efficient, innovative way, depending on the structure, unintended consequences can happen. So understanding, looking at these real-life case studies, talking to market experts, like Reggie, Dan, and others, there's a lot there. Simplistically, talking at a policy level may sound interesting, but there's a lot of second, third derivatives behind it.
Yeah, I guess if I could just add to that, I think what Reggie was saying earlier about unintended consequences, the first thing that'll happen is that people will set up offshore, right, in order to be able to trade that to avoid the tax. And we'll have, maybe there'll be note-based products or something else where I'll be getting the same exposure. But we've done two things. We've moved the trading and liquidity from the underlying component securities here, but we've now also taken those assets out of DTC and put them in another venue. And I don't think that we want to make ourselves less competitive. So I think it's a really bad idea. I think if you want less of something, tax it. If it's a good idea to tax it, let's put a big number on it. Is it $1 a share? What are we talking about? I mean, obviously it's going to show up immediately in the spread, right? And mom and pop are going to have a worse experience. So, I would just caution people, if that's the direction that we want to move, we really should step back and really evaluate it to see what the impacts are downstream.
Yeah, one last point. I think we want to encourage more companies to go public and seek capital and let the investor enjoy the rise in their success through market cap expansion. And we start introducing taxes and barriers, less companies will want to list here in the United States, and less opportunity for Americans to grow their savings for retirement because you have just barriers. And so I'm pretty passionate about this. I've been in the capital markets industry since 1984, and I've seen evolution over those several decades, not to label myself at my age. And we want full participation in the marketplace. There's 48% of American households who don't participate in the stock market. We want access to full deployment and full opportunities for all Americans. And when you start introducing artificial means, less Americans will save their money.
Yeah, and one of the problems with the financial transactions tax is it's more than just the direct tax you pay plus the higher spread, but by reducing the returns to investments, you reduce the value of investments, so that people who aren't directly participating in the equity market are still going to suffer, because they're going to see their pension plans that are investing for them are going to see lower returns, and consequently we're going to see higher costs of capital. So we're going to see basically every taxpayer is going to be paying more on interest on state and local debt, federal debt, and so forth. So there's a lot of impact there. But what other things should we be talking about in the ETP space? What are the questions that we're not asking that we should?
Into what respect?
We've talked about fixed income and the non-transparent ETFs. We've talked about ESG investing. We talked about the future. What else?
Well, I think digital assets is an ongoing topic by some. If you're fishing for that, I'll give it to you.
I was fishing for that.
If you're talking about digital assets, I would say not in this administration. I think there's a fear of the unknown, and bringing retail closer to that construct. I think we're not there yet. I know there's been a lot of work, a lot of proposals, a lot of ideas. I applaud the community for a lot of innovation to try to bring it forth. But I think we need more empirical evidence that there's a safety net around the structure. Look, the ETF structure around the distribution of assets is pretty efficient. If you were to put a Bitcoin inside of an ETF structure, the Bitcoin would trade more efficiently. I think some of the volatility would come down. I think the digital asset Bitcoin 100-day vol is 84 compared to 4 for a US dollar benchmark to a G20 currency basket. And so it's not a great store of wealth. And to put an ETF on top of it to make it more efficient, I think it's a bad thing for the ETF industry to propose that, because we'll spend a lot of time talking about it from a market structure perspective. So not to overtalk it, we have to be careful about what we put in the structure and make sure the innovation is right for all types of investors.
I'm sorry, Dan. I was going to say, if I could think about evolution, I think that the next change is going to be also not only happening at the asset manager level, but at the exchange level. So I would like to see the exchanges developing new order types for individual investors so they come down. And one of the things that I always found attractive would be doing something like a pegged order to the indicative value, right? So a client wouldn't be coming in and trading away from an indicative value. He could place an order, maybe it's a VWAP over 10 minutes pegged to an indicative value. But do things get a little bit more creative than what we're doing with today's order types on exchange? And anyway, I just think we have to continuously evolve these concepts.
Yeah. Sorry, I was going to say that I think there's a lot of interest in, I mentioned models before. We did a study, we estimated there's some 1,700 models in the world, and they're growing very quickly. I think it's a very exciting space, one that hasn't been studied, and I think ripe for a lot of innovation. And one where I think some of these questions about how those models are designed and how they offer diversification are great questions because they tie right into the big question, which is the retirement question. Right? These people who are 20-something following a robo-advisor in a model, they're going to be retired in 30, 40 years, and it'll be very interesting to see what those models look like, and compare them across advisors.
I was going to address the higher ecosystem for me. I kind of watch what's happening in the media industry. I'm not an expert, but as a consumer, and I think of this, now that we help, I think ETFs are in many ways one of the original fintech areas, right? Decades ago. But if I kind of look how I consume, now Disney will likely be leaving Netflix and creating its own platform, that focus on content and that value over time, will it be active and passive? Will it be equity fixed income alternatives? Will it be financial planning? I mean, all of these different ways, how will I consume my investment with the experience I have? And where will that content be? Again, if I'm choosing that you'll have the pipes and the distribution, which are becoming more commoditized every day, right? The Comcast versus the streaming versus the content where most of the value is, right? The billions that, say, a Netflix is putting into developing new content. I think this is really, in our space, you have the wrapper, but then that content developing, the active, non-transparent, and others, but the richness you can see coming more and more, that's at such a high level. How will we consume as investors in the future? There's just so much happening. But I look at other industries and look for parallels that may offer some path for where we're going.
I think that's all right. Just the one thing I was going to add back to order types is I think between models or whether it's consumer feedback into ETFs, I think those order types need to, the infrastructure around that, it has some evolution to be had. What I'm referring to is, a market order going right in through models. If there's any sort of less liquid ETFs or less screen volume, you can end up with less than ideal execution. So making sure that there are right order types available for the right model types, I think will just help facilitate both models as well as consumer-facing ETF investment.
I'm not a proponent of ETF-specific order types or rules. I think refinement around the buckets of market cap equities. So ETFs during a high-stress day is 40% of the volume on U.S. exchanges, both lit and non-lit venues. I'm for refinement of the marketplace that grows small cap equities, ETFs and small cap equities, corporate stocks together, so that there's a marketplace to allow for more capital aggregation, better price transparency and discovery, and have more investors come into the marketplace. And then to have just a patchwork where you have ETF-esque order types and then small cap order types is confusing. So reduce complexity, but look at it from a perspective of what's best for the small cap market, what's best for the mid cap market, and what's best for the large cap market, and define market structure around those three constructs to bring more investors in to allow investing on the aggregate to grow, and so that there's better education.
I think Reggie makes a great point about small caps. So one of the interesting things about the number of stocks in the United States is that they sort of peaked in the mid-90s, and they've been going down ever since. We now are in a situation in the United States where we have many more funds, ETFs and mutual funds, than there are stocks. There are probably about 3,000, 3,500 stocks that are quote unquote actively traded by some definition, but well over 10,000 funds. To encourage, I think, companies to go public, and particularly smaller companies, small and mid-cap companies, I think you do need to have a favorable regulatory framework to encourage that and to encourage capital raising through the markets, which is, I think, has numerous benefits.
Now it's time to open up the discussion to our audience. So if you have any questions, please line up at the microphones. Let's start over here.
My name is Li Yang. Thanks for the panel. I think a lot of time consumers are not protected, and everything has been robbed or stolen by our agencies and by our police department or attorney offices. I just wonder, is there anything study about all those misconduct and deprivation of consumers' access and income and employment status? Anything studied that you know of, and if you have any findings?
Consumer protection. What kind of consumer protection do we have in the ETP space? I think we have a lot. Who'd like to?
Simplest level, I mean, obviously you can sell the product. The products aren't going to be approved and come to market unless there's adequate liquidity. So that's your best form of risk management potentially.
I'll just say the wrapper is the most transparent wrapper there is. I mean, so if you think about mutual fund disclosures, those are sort of typically monthly or quarterly. ETF, it's daily transparency, T+1. We know this very well, and so that's a huge huge benefit to the consumer to understand what is in what they invest in.
I agree.
I think that the advantage also from that perspective is having an SRO. I think the exchanges do a very good job regulating themselves and making sure that they have the right infrastructure to be able to support the product that are brought to market.
Yes. Over here?
There was a comment about, John Davidson from OCC again, there was a comment about leverage in the industry. One of the fastest growing areas of the listed options business in the United States are options on ETFs. And I wonder if the panel has comments on the advantages and disadvantages of the growth of listed derivatives on ETF underliers.
Okay, let me take that one. I think it's a huge positive because the ability to write options or buy options can give you, desired risk-return trade-offs. So, for example, if I'm long EFA and the international stocks, and I want downside protection, I can buy a put option, and I've bought myself some downside protection. That's good. I think the key point I would emphasize with the option market, the listed option market, is that options are side bets on the value of primary securities. So for everybody that bought a put option, somebody wrote a put option. So it's in zero net supply. So these are people who are willing to, for whatever reason, express their views on these underlying securities. Those abilities to shape the return distribution is nothing but just an added benefit.
Over here?
Thank you so much for this opportunity. I noticed a couple of links throughout these talks so far. I think Professor Rowan Williamson mentioned financial literacy as one of the barriers for, I guess, regular people, general public, to sort of be a part of these conversations. And I guess I kind of feel a little disappointed because I think being at Georgetown, you expect a level of pedagogy that's going to make things very clear, accessible. And I feel like this has been a missed opportunity. And so one of the reasons I bring this up is because I think there's this idea of anti-intellectualism that regular people aren't making complex financial decisions every day. They just might not be at the scale that we're talking about here. So I guess my question is one, how do we, I guess, kind of recuperate the event? Because it's going to be online, and people who might not be able to pay tuition here might be watching this to sort of better themselves. So how do we really make this accessible to people who we call financially illiterate? And on the other hand, because I don't think they're financially illiterate, I think what might be happening is that the demands that they have might be antithetical to sort of the work that y'all are doing. And so I guess, you can pick and choose which approach you want to take, giving options. I guess, how do we sort of really take this opportunity as an educational institution to make the knowledge that we're talking about accessible and to answer some of the deep questions about, okay, what if the people are actually just asking y'all to just do things like radically differently? What do we say then? I hope my question makes sense. Sorry.
I'll take that. It's a great question. I would answer by saying that, first, the retail firms do a terrific job of making education accessible and available. So Schwab, Fidelity, Vanguard, Raymond James. If you go on our website, there is plenty of accessible education around just how to think about opening an account, how to best think about investing in the stock market, and what are the first steps. So I think the first step is having desire and willingness and the curiosity to seek the information. And once you seek it, how best to go find it. And so not only do the retail firms have this, but the regulatory bodies particularly has a great level of information that's accessible around all the various asset classes and what are the best practices.
To say just earlier, understanding of basic financial planning principles. At an earlier stage, being able to, even in elementary schools, things about debt and leverage, for example, the impact it can have on you. What is a FICO score? How, and especially in this digital age now for younger people, what are these implications even earlier in your life that can have on the ability for you to save and invest and kind of go for those goals going forward? So there is a lot of complexity. We get into a lot of the nuance, but I think there's a much higher level of explanation in society. And in a digital age, that responsibility is being pushed on younger people earlier and earlier in life.
And we have time for one more over at this microphone.
Hi, I'm Vanetta Young, a business coach for emerging private equity managers. She actually kind of stole my question, so I'm going to ask another one, which is something that Reggie mentioned very early on, is the now zero trading fees for ETFs. And I just actually want to clarify what the benefit of that is for platforms, since they're now no longer getting the commission from these fees. What exactly, why do that rather than, for example, I know there's a lot of competition with the Robinhoods and those sorts of new startups. Why not just acquire one of those? What's the benefit of doing this?
Multiple revenue streams. I could offer, again, if you think about the internet is quote unquote offered for free, but there are many, many ways to generate different revenues. I would just say, without naming any firms, there could be still custody, administrative fees. You could have securities lending. You could get different types of fees for portfolios or asset allocation. So and again, that's why I used that media analogy earlier. That's where, for me, if you think about ways that once you have, as a consumer, and increasingly your data is on that platform, there is potentially tremendous value to keep you in that ecosystem. So I think that's a high level, but I think we're now seeing, for I think most of us, the war to kind of zero commissions, it's been telegraphed for quite a while.
Sure.
It's happened, and I think the most immediate thing was you saw another provider who responded to that initial cut. There was a lot of money that was made, frankly, on money markets and cash. That changed that economics as well quite quickly, as well in favor of consumers.
Yeah, and besides the monetization, I think, which I'm in full agreement with, I think there's also this element of, zero commission ETFs, very easy then for retail customers to follow models. They're not worried about, we're getting these little odd ticketing charges here and there when the model allocation shifts from 65% to 63%. So I think it's related to that as well. There's an element of the platform see growth in the model space, and this is a response to that.
Well, this has been a wonderful conversation. I'm sorry, but that's all we have time for. So let's give our panelists a round of applause. Thank you.